A portfolio app may display impressive gains today, but the reality is that losses can appear just as quickly tomorrow. Trades can provide a sense of productivity, but excessive activity often replaces genuine understanding, turning investing into a frantic pursuit. This shift occurs when decisions are driven by market trends, quick profit tails, and misplaced trust rather than a clear, coherent strategy. Speculation zeroes in on perceived future values, transforming price movements into the main commodity being bought and sold. The risk isn't just diminished returns, it can lead to significant financial losses when the collective mindset shifts. When confidence wanes, many investors respond emotionally, often making poor timing decisions and repeating past mistakes. Someone hears a market tip, acts impulsively, and then checks the price incessantly for validation. In contrast, another individual evaluates the underlying value of a business and waits for a clear divergence between price and worth before acting. Next, we will distinguish between investing and speculation, analyze market pressures, and adopt a risk-first perspective on purchasing. This video draws inspiration from Margin of Safety by Seth Klarman, so be sure to subscribe for practical value investing principles. Investing means acquiring a stake in a business, or extending a loan and patiently waiting for inherent value to manifest. Profits arise from cash flow, dividends, elevated valuation multiples, or the narrowing difference between market price and business value. Speculation involves buying and selling based solely on anticipated price changes. This process revolves around predicting the actions of other traders rather than assessing the underlying business fundamentals. Fundamental analysis directs focus onto assets owned and their potential to generate returns over time. Speculative thought treats stocks as mere paper to be traded frequently, often neglecting investment basics. One investor carefully examines how a company generates income and whether that revenue can consistently grow over the coming years. Another keeps an eye on the latest headlines, attempting to trade ahead of others, relying on speed rather than knowledge. This contrast highlights why thorough valuation and patience are essential, as opposed to mere market activity. A practical next step involves articulating what criteria would justify a purchase and what evidence could disprove that thesis. Market dynamics can distract investors from core business fundamentals, pushing them to react impulsively to price fluctuations. Performance pressures, compensation structures, and a chaotic environment make it challenging to maintain long-term thinking. In a competition for relative performance, fleeting price changes often dominate the focus for many institutions. Following the latest market trends can feel safer than taking a stand, even when the reasoning is weak. As prices rise, greed typically escalates, driving people toward high-risk investments based on overly optimistic projections. Conversely, fear intensifies when prices drop, focusing attention on potential losses while investment fundamentals fade into oblivion. Some investors might memorize a few rules and seem skilled, but they often lack a real understanding of the concepts behind those rules. To thrive over different market cycles, it's crucial to grasp the rationale underlying investment strategies, rather than merely reciting them like a formula. This strategy maintains focus on risk management and decision quality, rather than the emotional fluctuations of any given month. A beneficial first step is to identify incentive traps, followed by establishing routines that encourage deliberate decision-making and value-independent judgment. Fundamental analysis views a stock as a fractional share of the business it represents. This viewpoint shifts attention from noise about prices to essential factors like cash flow, balance sheet strength, and long-term economic sustainability. Value investing is a subtype of fundamental analysis that begins with estimating the underlying numerical value of an asset. The strategy involves purchasing only when the market price is significantly lower than its estimated value, providing a margin for error. While this discipline may sound simple, executing it can be challenging, as it requires patience and self-restraint. It also involves the need to sell when prices no longer represent a good opportunity, even if popular sentiment suggests a continuing upward trend. An investor seeking immediate action might frequently trade, perceiving that activity provides a sense of control in uncertain markets. A value investor can afford to wait, as the objective is to acquire quality assets rather than to trade frequently for the sake of activity. This perspective replaces an unhealthy obsession with short-term performance by fostering a steady commitment to preserving capital and avoiding significant mistakes. If this risk-aware investment approach resonates with you, consider subscribing for more practical insights on decision-making amidst uncertainty. A margin of safety signifies purchasing with a buffer, ensuring that mistakes do not lead to substantial and lasting losses. This buffer is crucial because valuation can be imprecise, the future remains unpredictable, and everyone is susceptible to errors. Having this cushion alters outcomes by allowing space for unforeseen bad luck, analytical misjudgments, and delays in market timing. Without such a buffer, one erroneous assumption could wipe out years of carefully accumulated savings and investment plans. During periods of steady price increases, undervalued securities may underperform, making a value approach seem less advantageous. Value investors may prematurely exit their positions when markets reach full valuation, prior to entering overvalued territory. The most advantageous moments for value discipline often emerge during market downturns, when downside risk becomes critical. This is when unwarranted optimism is challenged, and a focus on potential pitfalls becomes essential for protection. This concept emphasizes avoiding detrimental strategies by prioritizing risk management over pursuing popular trends. A practical next step is estimating value conservatively and committing to purchase only when prices reflect a significant discount. Speculative investments offer the allure of quick returns, as the prospect of sudden wealth is more appealing than gradual accumulation. It also provides a sense of security in numbers, where being part of a group can feel like safety. These behaviours can lead to a greater fool scenario, where investors purchase overpriced assets in hopes of reselling them at a higher price later. Many participants might not recognise they are engaging in speculation, as rising markets can create an illusion of easy profitability. A tale about trading sardines illustrates this phenomenon, where buyers push prices up without concern for the edibility of the goods. When a buyer opens the can and falls ill, the seller simply points out that they were trading sardines, not selling food for consumption. Viewing stocks merely as trading instruments requires minimal understanding of the businesses they represent. This approach replaces thorough analysis with mere predictions of others' behaviours, which heightens risk when market sentiment changes suddenly. This ties back to the importance of value discipline. Truly understanding a business serves as a guard against crowd-driven speculation. The essential next question is to consider what assets you own, their true worth, and the rationale behind their current prices. The objective isn't constant buying and selling, but making informed decisions that safeguard your capital while allowing time to work in your favour. Markets will always offer tempting shortcuts, so it's wiser to establish a strategy that can withstand stress and unexpected events. You witness that speculation centres on predicting what others will pay next, while investing focuses on owning businesses and their ability to generate cash. You also recognise that incentives and emotions often distract from long-term business fundamentals, leading to a fixation on short-term price fluctuations. A value-oriented approach brings discipline by assessing intrinsic value and purchasing only when there's a significant discount. A margin of safety acts as a buffer against mistakes, preventing minor errors from escalating into major problems and promoting humility in forecasting. Begin by crafting a definition of investing that you can communicate without relying on market jargon or fleeting price predictions. Make it a habit to pass on opportunities that don't present a clear discount, even if they seem popular or exciting. Over time, steering clear of significant mistakes is just as crucial as identifying the best investment opportunities. If you're interested, subscribe for more insights on maintaining a rational, patient, and risk-aware mindset in noisy market conditions.